So what we do right now is to learn the forces, what actually drives the principle behind the forex market. Behind the forex market. Without this principle, let's stop your account in the forex market. Now, with the aid of these five forces, we have five forces. Five forces, what we are going to be talking about today.
Why?
Because if
Yeah.
you are doing technical analysis, you are doing in fundamental analysis, we can hear some background noise. If there's any way we could mute ourselves so that I won't get disturbed. Please, let's mute ourselves. Let's mute ourselves. Thank you, thank you, thank you, thank you so much. So now, basically, the mistakes we traders make, especially the Nigerian trader, what we did is, what we do most times is we forget to learn this basic principle. And this basic principle, even in for those of us that trade derived, for those of us that trade derived, even derived too, if you make this mistake, when I'm talking about derived, I'm talking about binary, talking about the boom and crash, talking about the VIN 75, those ones, if you forget this principle, this basic principle, no matter how your technical analysis is, no matter how good you are in technical analysis, you will definitely F up. So that is why I'm starting with this basic, which is the fundamental basic of Forex, whether synthetic or the normal Forex, talking about currency pair, commodity, and the rest. So without further ado, we're going to start. The forces of this Forex is what actually guides it, and is divided into five, which is the who. I believe we all know the who. The why. The who is who trade the forex market. Who are the people that actually trade this forex market? That we're talking about the who. Then talking about the why. The why is actually why should you trade forex market? Then after why, after asking yourself the why, then you talk about what. What in terms of what currency pair should you trade? What currency pair should you trade? Then after talking about what currency pair should you trade, talk about when. When actually, is it the New York session, the London session, the Tokyo, or the Sydney session? But most people forget this principle, the basic principle. All they do is just enter the market and start trading, and it is very, 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 very wrong to do that. Very, very wrong to do that without answering this question. Then the last forces is how. How? Talking about your trade plan, talking about your trading plan, talking about journal, jotting down every detail of what you do. And you find out that this number 5 is actually the basic problem we have as trader. We don't have trading plan. We are not disciplined to our trading plans, and we don't have a guide. And that is what kills most African traders. And if we understand this basic as a trader, no matter how hard it is, definitely we will succeed in Forex. Then the concluding steps, you need a trading plan and build a strong strategy and trade with journal. Journal all your trade. No matter how good you are, if you don't journal your trade, you can see as having problems. So if we understand this principle, we're going to be talking about the why, the who first. Currently, we're going to be talking about the who. So this is the RSA, you can see. This is the RSA, the who, the why, the what, the when, and the how. So the 5 forces. For example, now I'm going to, for example, now what you see here, this diagram you see here is a pool of fish moving in a direction. If you are close to the river area, you understand that when you see a pool of fish, they are moving in a good and a harmonic direction. But all of a sudden, see this thing scattered. If you don't understand the thing that led to the starting of this fish, you can't predict the direction of where the fish is going to. So this is why, as a forex trader, when trading most times, people just enter the market without knowing the cause of the movement. Why, like for example, now if we're in a bear trend, maybe the direction of the bear trend, you don't know why it's going down. All we are care about is I want to make money, I want to make money, I want to make money. No, no, no. Forex is more than that. Forex is more than that. It is more than that. So when you know the what, the who, the why, and the how, then, then your strategy will not be a failure. Now let's start with the first of them, which was the who trade Forex. I believe this is not this is not a new topic, talking about the people that trade Forex. But I'm going to simplify it into this chart you see here. The who about Forex. The government, yes, don't be surprised. The government who trades Forex. The government trades Forex. Then we have the institute. We have specific institutes, but funny enough, we don't have that in Nigeria. We don't even have the hedge fund in Nigeria. The only people that trade Forex in Nigeria as the first thing, I think, is the bank and the government. But we don't have institutes. But in the civilized world, like in UK, US, we have institutes that their work, the company is built to trade the forex market. So if you think that the forex market is just a, a small market, you are wrong. Institutes, like they are registered and they trade forex. We have the bank, we have the hedge fund, and we are called the retail traders. Are called the retail traders because we are the minimum people in the market. We don't really have much of a space in the market. So now, these people that trade this forex market, they have motive. They have motive of trading this market, and this motive is what shaping and what makes the market different. For example, now we have the institute, we have the hedge fund, we have the government, we have the bank. They all have their idea. Even you as a retail trader, we all have our different ideas, and this different idea is what moves the market. This different idea is what moves the market. For example, now I believe with time you get to know about the trading of new NFT, the Fed fees, and the central bank fees, and you discover that when such fees are going on, you see that the market is very volatile. You know why the market is very volatile during that period is because the institutes, even the retail trader, the bank, and everybody, they are watching and looking to know the next decision to take from the decision of either the government or from the Fed. So you see that during fundamental speeches, during fundamental analysis, you see that the market is moving drastically. So this perspective of everybody is what makes the market unique. For example, now my trading goal, my plans, my idea towards Forex is different from everybody in this platform currently. So, for example, now my bias might be to buy, yours is to sell. So the amount of buyer varies. So if the amount of buyer is higher, definitely the buyer will take charge, meaning the bull people will take charge. Then the level of experience, whether you like it or not, as a retail trader, our level of experience is not to be compared with institution and the federal government and the hedge fund, because those guys, they do a lot of research. When I mean a lot of research, massive research, just to make sure that their trade goes on very, very, very well. And in terms of money management, The money they put in Forex, like if they are opening a position, most times our position, the highest position you see as a retail trader is, say 20 lot size. A normal retail trader, you see them trading 20 lot size. But if you see these guys, the institute, the hedge fund, you see them even using billions to trade. And I believe you, that billion, immediately they trigger a trade, there will be a shift in the market. And their level of discipline as a, like retail trader, you can trade anytime you like, but the institute, the government, and the hedge fund and bank, they are strict. They are very, 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 very disciplined. So that is the element behind the who. Then why should you trade Forex? Why should we trade Forex? One, I simplify it by saying the liquidity ratio. Liquidity, you can make liquidity has to do with the movement of price. For example, now if you are trading, if you are used to the synthetic market, you discover that you can in a day you can get more than 1,000 pips. And then you can get more than 1,000 pips. Then talking about convenience, you can trade from your house, and the cost is really really cheap. With your $10 account, you can flip your account to $100. So the convenience and everything. So forex trading is actually one of the most interesting business I have ever seen, because it is very, very, very easy and convenient when you know the basics. When you know the basics. Yes, I know. I believe some people will be waiting to see technical analysis, but if you don't understand these fundamentals of trading, you will miss it all. You will miss it. That's why I'm taking my time to give you these fundamentals, to give you this principle that will shaping your trading on a long run, on a long run, on a long run. Then now, I'll talk about what should you trade. You see most beginner, most traders, what they do immediately they enter the market, they will see this pair, gold, they will trade gold, they will trade Euro USD, they will trade GBP USD, they will trade CAD, JPY. As in, they don't have specific pair that they trade. And that is a very, 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 very wrong approach. As a beginner, you should not trade more than one pair. As a beginner, you use that one pair to follow up your trade. What do I mean? For example, now, as a beginner, you start with, say, Euro USD. With that Euro USD, you have to build that Euro USD, understand what causes the movement, which trend, and what is the thing that actually move this pair. If you don't understand this basic, you go wrong. Like I made an example here about the Bitcoin. I think okay, this is the Bitcoin. Looking at this chart here currently, this is the Bitcoin, and I did a research on the Bitcoin, talking about from last year December down to this August. You discover that the Bitcoin has been in a bear mode. The Bitcoin has been in a bear mode. The Bitcoin has been in a bear mode. But you hear people saying, buy the dip, right from December. People have been buying the dip, buying the dip, buying the dip, buying the dip, buying the dip. And currently, people are still buying the dip. And they are still losing money without understanding, okay, what's the cause of this bearish movement? What can be done? Okay, no research, nothing. All they see, the market is going down, good opportunity to buy, and they buy and they end up losing money. So you should understand this principle. Then when should you trade? We have different in the forex market. We have different sessions. We have different sessions. If we should observe this my chart, you observe this little box here, you discover that volatility around this box is very, 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 very minimal. Volatility around this box is very, very, very minimal. because during this session, which is the Sydney and the Tokyo session, no much trader, no much business is happening. But you discover that immediately the London session opened, you see volatility down from this zone to here. You see volatility. So if as a beginner trader, you don't understand that the best time to trade is during London and New York session. What I mean London, and the most suitable time to trade is when the New York and the London session meet. That is when you see a specific direction, you see movement, you see the movement being straight. If you don't understand that this is the right time to trade, you will lose money because during this New York and during this Tokyo and Sydney session, the market is unpredictable. The market is unpredictable. So understanding sessions. So in this kind of this, people develop breakout sessions like strategy, whereby immediately the market opens, there's a specific move, like 20 to 40 pips. 20 to 40 pips. Those people, they strategize a good strategy and they run with it, and they are making hell of the money understanding session. Understanding session. Not trading. You see some people trading New York, and during the Tokyo and the Sydney session, you see that the spread is usually high. The spread is usually high. So that is why it is advisable to know the session that you should trade. Know the session that you as a trader should trade. After knowing, okay, this is the pair I'm trading, so the next thing you know is what am I trading and which session am I trading. Then we'll talk about the how should you trade. You see some, I said trading currency. What currency are you trading? What strategy are you using? Okay, what is the reason of me buying or selling a pair? Okay, what is the risk management I'm going to take? Am I losing 20 or 40% of what of my capital? These are some of the things you have to look. Say what pair am I trading? What are the factors that trigger my buying or my selling? And what money managing strategy I'm using? These are some of the things you need to pay attention to. You need to pay attention to as a forex trader. So what are the factors that trigger your buying and selling? First of all, you have to consider the fundamental analysis. What is the Fed saying? What is the inflation rate? What business cycle? What business cycle is currently ongoing in that economy? It's not just going to market. Is the currency you are trading or the commodity you are trading, is it a safe haven currency or is it a commodity dependent currency? For example, the Euro USD. The USD is a safe haven currency, and the CAD is a what? Commodity dependent currency, meaning the Canadian dollar depends on export and import. Is a commodity dependent currency. So when the price of oil is affected, it will have an effect in the Canadian dollars. And for example, too, the Euro USD, which is a safe haven currency, when there is financial crisis, when there's global crisis, when there's threats, this currency tends to go high because people have confidence in them. Gold is a safe haven currency. When there's crisis, you see the prices of gold going up. These are some of the factors you need to consider before even thinking of going to technical analysis. Using your indicator like the RSI, BB Bank, the Fractal, the Iskomoshi, and the rest of them, then you look at your candlestick pattern. These are some of the factors you have to look before thinking of entering a trade. Then retracement factors. These are some of the factors you have to definitely look before taking any of these trades. So that is it. Then another thing you need to consider is your entry point, your stop loss, and your take profit. You don't start a trade without getting these things. Your entry point, your stop loss, and your take profit. These three things you must have them on your mind. Place them before even thinking of entering a trade. If not, you will just enter the trade blindly, and I'm telling you, you will lose a lot of money. And these are some of the things that most traders forget to know. That is why you see them blowing accounts. I remember back then, while I was still learning, I'll think that probably the broker is fighting me, because immediately I open trade, that's when the market is going down. Probably I buy, that's when the market is going down. I came to understand that you need to have understanding of this thing. Take a look at this chart. Look at this chart. You look at this chart properly. This is one of my analysis I did. That was late July, before, during the time I was writing this book. For example, now this is a typical example of before I took the trade. This is gold against the dollar. Before taking this trade, I had to like do my analysis. First of all, the pattern you are seeing here is a what? Is a descending triangle. It's a descending. I already know that it's descending triangle, so I need like 7. Most times before I take a trade, I get nothing less than 7 confirmations. When I miss nothing less than 7 confirmations before I trigger a trade. So now I've already confirmed. This is one of my confirmations. The first confirmation I've seen there is a descending triangle. Then using my retracement, which is the Fibonacci. Using my Fibonacci, I understood that it's a good place, which is this region here. I don't know if you can see this region. This region here is a good place to take a trade. Then going down to your lower time frame, you discover, going down to your lower time frame, you use, most times when I'm doing my trade, I use my I use lower time frame to look for patterns, candlestick pattern. You don't look for candlestick pattern most times, except you are a swing trader, you trade long. So you go to your lower time frame to look for candlestick pattern. So what I did, I had to look for candlestick pattern in my lower time frame. Sorry, it's not here. Then the next thing I did, I trigger a trade, I trigger a sell trade, and after probably some minutes, this is what happened. And if you should observe, my stop loss has already been, I've already broken even after the trade. I didn't thought of this class, so I would have shown you my stop loss was at this region. My entry, the green place was my entry price, which is this one here, the green, my entry price. Then my stop loss was above. Okay, if you see, I did something here. I did a buy stop. I did a buy stop, and I did a buy stop and a sell signal. I did a buy stop and I took a sell. So should in case this my trend line is being broken, I will know that this is a confirmation for a buy. So I did a buy stop. Can you hear me?